Hey everyone, welcome back to this episode of A Good Problem to Have. I am your host, Tyler Olson, and today I'm joined by Matt Graham. Matt is a specialist in the lending and interest rate markets, and he runs mbslive.net. And we're going to be talking about a couple of things today. We're going to be talking about the current landscape politically and economically that leads to our mortgage rates, talk about a couple of examples, and then maybe some actionable things that can be done. I really appreciate you taking some time today, Matt. It's good to have you here.
Thanks. Great to be here, Tyler.
Yeah, if you don't mind, what can you just share briefly what you do on a day-to-day basis?
Sure. So MBS Live is the product that I wish that I had had back in the day when I was originating loans, because in our world, rates and rate volatility are driven by MBS or mortgage-backed securities. Those are the bonds that mortgages turn into in order to be traded on the secondary market. And the trading of those MBS causes price movement, just like you see price movement or yield movement in US Treasuries. And that movement in turn lets lenders know how to set their mortgage rates on any given day. So because that's a bit of an opaque market, there is a demand for real-time MBS prices among loan originators so they can see what's going on sort of before a mortgage lender will actually go to the trouble of changing their rates for the day, because those mortgage lenders sort of are battleships in a river when it comes to changing rates. So MBS Live gives insight into how that's moving throughout the day. And then we also do analysis and offer tools for mortgage professionals to build their businesses. In addition to that, I write for mortgagenewsdaily.com, and we pioneered what, if I can be a little bit biased, the best daily mortgage rate tracker out there. And that's gained quite a bit of popularity in recent years because it's nimble and it's based on actual lender rate sheets. So I keep track of that and make sure the math is dialed in terms of how we calculate it, so that I can keep the general public informed on how rates are really moving on any given day.
There is a lot going on behind the scenes beyond like what our our mortgage brokers and bankers are telling us consumers. I can see.
For sure, yeah.
Yeah. All right. Cool. Well, I get asked a few questions consistently, and more so in the past 4 to 6 months than I have in quite a while, because rates have, they were so low before, and now they're higher, I should say, relative to,
Right.
2021. Um, and now there's just a lot of news, both economically and politically, around mortgage rates and interest rates. And so I wanted to ask you first, what what's the current landscape that we're in that leads to mortgage rate ranges being what they are? Like what you could say about now, but just generally too.
Yeah, I mean, just a simple little question with a very short answer, right?
I'm
So
sure.
a lot goes into it, as I'm sure you know, and we have to consider arcane stuff such as the way the Fed was participating in the bond market in the post-financial crisis timeframe, and how that sort of one could look at it from an economic standpoint or from an intervention standpoint. And either way, rates were arguably artificially compressed to be as low as they could be for a very long time. And that process was beginning to end in 2018, early 2019. And then trade tensions with China sort of brought rates back down 2019. And then, of course, COVID caused rates to go significantly lower due to the aggressive stimulus on both sides of the coin, but primarily via the Fed's quantitative easing. And that, of course, caused the big inflation problem that I'm sure you and your audience are familiar with. And we'll probably talk more about this by and by, but inflation is a mortal enemy of rates. So, in general, the higher inflation is, the higher rates are going to be. And the hyperinflationary period that began, whenever you want to say it began, maybe 2021, but certainly 2022, resulted in the Fed rapidly pulling back all of their accommodative policies surrounding not just their policy rate, but more importantly, quantitative easing.
Hmm.
That meant they weren't buying the stuff that makes mortgage rates low, those MBS. And combine that with rising inflation and economic boom, higher asset valuations, all of these things are bad for rates. Combine that additionally with rampant Treasury issuance, and this is not a red or a blue problem. This is a government problem, and it's a little bit of a complicated walk to see how that connects to rates. But think of it like this: Treasuries are sort of like the vanilla ingredient that provide a common thread across the world of interest rates. So if mortgages are a pizza or a cake, then treasuries would be like the flour that those are baked with. And apologies to gluten-free members of your audience. And so when the government is issuing a ton of treasuries, that's increasing the supply. And then supply demand 101 tells us higher supply means lower prices. When we have lower prices in the bond market, that means higher yields or rates. And that's really the simplest way to convey how treasury issuance via things, like lower revenue or higher government spending end up flowing through to upward pressure on consumer rates. Even though a 10-year treasury is used as a benchmark for mortgages, that's not exactly the same thing, but they do tend to move in the same direction by roughly similar amounts because all of that debt is very similar in terms of the way it's viewed by investors. So treasury issuance, lack of support from the Fed, and maybe some sort of rebound effect from years and years of overly low rates.
Yeah. 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 And I like, as you're like taking me through memory lane as you're talking about, like, even back to the financial crisis. Um, I remember when that all began, the QE easing, and there was so much talk about it. And I can't believe it had been going on for so long when you think
Oh
about it.
yeah, it was
Uh,
hard drug to get off once we got addicted.
yeah.
But it's definitely the primary transmission mechanism that exists between the Fed and the mortgage market. A lot of people conflate the Fed funds rate with something that matters to mortgage rates, and it's really not quite that simple, which I'm sure we'll end up discussing here in a minute.
Yeah. And that was another question. I'm glad you brought that up. So, um, I mean, with the assumption that you agree and it's accurate because you're the expert on this in this area, that mortgage rates track the 10-year Treasury note, um, why do mortgage rates not closely follow the rise and fall of the Fed funds rate?
Two really big reasons, and fortunately, I think they're pretty simple. Number one is the nature of what the Fed funds rate is versus what a mortgage rate is, and we'll rewind just a second and talk about bond investors because ultimately it's demand among those bond investors that are driving the changes in these rates. Of course, the Fed is setting the Fed funds rate, but really they're beholden to what's happening in the financial market. And, the Fed's a reaction function, basically. And we know if we feed the Fed a certain set of parameters, they'll likely do one thing or another.
Mm-hmm.
So the Fed funds rate applies to loans that are overnight or 24-hour loans, very short duration. And this is why I brought up what's important to bond investors, because a critical consideration for an investor in the bond market is how long the thing lasts. If I know that I am going to earn a certain rate of interest for 24 hours versus 10 years, I have a very different set of expectations for the rate of return that I want on those things. And so for that reason alone, because a mortgage can last for 30 years and a loan that's based on the Fed funds rate only lasts overnight, they're going to perform differently. And anybody can pull up a chart of the Treasury yield curve, which is the difference between a 2-year and a 10-year note, and see how wildly that can fluctuate over the years. And the Fed funds rate is even more short term than a 2-year Treasury. And to whatever extent that can fluctuate, mortgage rates can differ from a short term Fed funds rate. So that's the first reason, fundamental difference in duration. And even though a mortgage is a 30-year product in most cases, or a 15-year product in fewer cases, they don't last that long because people refi or move or whatever. So the investment community considers them to have a certain duration of sort of a moving target. You could call it 7 years, you could call it 5 years, call it 10 years. It changes depending on the environment. But even if it's not 30 years, it's still at least 5 to 7. And if it's 5 to 7, it is still very, very different from the Fed funds rate. And you can certainly see those differences even in treasuries. Mortgages also have other considerations a little bit different than treasuries because the people that hold them can opt to refinance, whereas the US government can't do that with treasuries. So there's another little layer of complexity there. And it means that when rates are moving in a volatile way, investors start to expect different behavior from consumers, and that can have an impact on rates. If they think they're going to get their money back sooner than they want, then they might need to charge a little bit more interest because they know they're going to have to put that money back to work at lower rates of return in the future in a scenario where rates are falling. Okay, so that covers the duration aspect. Hopefully that made sense.
Yeah.
The far simpler is the fact that the Fed only meets 8 times a year to set rates. People talk about emergency cuts and things like that, but that's very rare. And we haven't been close to an emergency cut for quite a long time, not since the outbreak of COVID. And what that means is that everything that's happening in the market and the news, everything that's feeding into the Fed's reaction function is something that the bond market and those bonds that dictate mortgage rates are part of that. Something that the bond market has time to react to, not just every day, but every second, multiple times per second. And that means that rates are going to adjust to whatever reality they can understand or expect in relative real time. And the Fed is just basically showing up and confirming, yeah, the reaction function is what you guys thought. Here's your rate cut. So by the time the Fed gets around to cutting rates, the market has long since traded that in to consumer rates and longer term rates like mortgages. The market has long since traded that into treasury yields. And you won't see a reaction to a Fed rate cut unless that rate cut is an absolute surprise. The Fed has far more power to cause a reaction on Fed Day via things like a press conference with Fed Chair Powell, or via the dot plot, which is a reference to the summary of economic projections, where each Fed member says where they think the Fed funds rate is going to be at various points in the coming years. But the rate itself, not news. And oftentimes, in fact, the last 2 rate cuts that have come after a period of ground holding have seen mortgage rates go higher in their immediate wake because the rate cut itself is so well understood and already very much priced into the market.
Mm-hmm. Yeah, that even just happened a few weeks ago. I remember
Yeah.
I got several calls from uh, people, both clients and non-clients, being like, "Oh, they're cutting rates. I'm gonna call my broker,"
Yep.
and they're like, "Actually, rates are a little bit higher now." And they're like, "Wait, what?"
Yep. That's so common. It's even common among industry professionals that don't end up, digging into our sort of our efforts at MBS Live. Not everybody is wanting to get that detailed with what's driving the underlying market, but yeah, it would be a blessing to everybody if we all understood that the Fed cutting rates doesn't mean mortgage rates are going to be lower.
Yeah, yeah. So, and in this realm, this might be getting more technical for some, but there's a lot of people that listen that show an interest in learning. So I have a question for you that I was wondering about. There is like a margin, a range of the margin between average mortgage rates and the 10-year treasury, and that ebbs and flows over time. And
Right.
you wrote something about that. I mean, I'm sure you write about it all the time, but there was an article that I think you wrote in 2023 where you were even speaking an about this relationship that's
The
very much,
spread, the
yeah,
spread.
there it is, the spread. Can you speak to that?
I can. Yeah, people are really focused on it right now. And I think part of it comes from desperation for any relief for relatively higher mortgage rates. And the spread between mortgage rates and treasuries, or what they call the primary secondary spread, is it's really a byproduct of other stuff. And various things are going to incrementally increase or decrease demand for mortgage debt relative to treasury debt. And here again, to go back to an earlier point, we just want to think of that treasury debt like vanilla. It's the most risk-free and the most basic form of an interest rate that's out there. So it's just a yardstick by which all other rates are measured. You could think of something like a big corporation offering a corporate bond that's going to be priced in a spread versus Treasuries. And part of the consideration will have to do with the duration of the tranches that are in that corporate bond. And so if some big companies, doing a $10 billion, $15 billion bond, they're not going to do it all in one maturity, one time frame. They're going to say, well, we're going to do one tranche at 2 years, one at 5, one at 7, one at 10, maybe one at 30. And so each of those is going to be measured against a comparable Treasury yardstick. And if we're in a moment where super long-term debt is not doing as well as short-term debt, which was the case for much of the time that the yield curve was inverted, then the rates on that longer-term debt would be lower. And when we look at the spread between mortgage rates and Treasuries, the market, it's easiest to use the 10-year because the 10-year's always been pretty good at that. But at many times, it's actually the 5-year that's better, especially when the market is expecting rates to fall enough for a lot of people to refi. That's going to necessarily increase or decrease the duration of the average mortgage. And it's going to make better sense for it to be compared against the 5-year. Other things that can affect specific demand for MBS would be things like the Fed exiting QE and the way it does that. Also, quantitative tightening, letting those assets roll off their balance sheet by not reinvesting the proceeds from the stuff they already bought. Mm-hmm. So the Fed bought a bunch of MBS, bought a bunch of Treasuries, and as it has undertaken quantitative tightening, which they just announced the end of, at some point they said, we're not going to reinvest the MBS proceeds back in MBS anymore. We don't really want to be in the MBS game as much as we used to. This is something that's been coming down the pike for a long time. But they said we're instead going to reinvest MBS into Treasuries. That's naturally going to create an incremental benefit for Treasuries and an incremental detriment for MBS. And that's something that would cause that spread to widen. Another thing that can cause the spread to widen is this notion of prepayment expectations. The word prepayment in the mortgage world is a bit specialized, but it just basically means you're going to sell a refi. And I suppose during the financial crisis, it could have to do with foreclosures or short sales too. But the primary reason a mortgage is retired is because somebody's refinancing or selling their home.
Right.
In an environment where rates are really high and people are hoping there's going to be a reason for them to go lower, even if it's just, 1% lower, enough for a lot of people to have a refi incentive, then investors are going to worry, hey, this MBS that I bought is going to go away soon. So if I bought this thing expecting a 7% rate of return, and I think that, rates are falling to 6%, well, my 7% rate of return is going to get paid off, and now I'm going to have to put my money back to work at 6%. So when rates go much higher than they were, especially when they're very high relative to most of everybody's frame of reference, there's this fear, some expectation, some fear, that they're going to go low enough to ramp up this prepayment speed. And that is going to make investors hesitate to bid aggressively on new MBS. And so here we are, supply and demand again. That would be a lower demand side of the equation this time. That's going to make MBS prices be lower, and that's going to make mortgage rates be higher relatively. So all that to say, in general, one big factor driving high spreads or higher spreads than we used to see is the fact that rates went so high so quickly and are just elevated relative to our worldview. And if we were to stay here for a long time, and if there were not to be any relief on the horizon for government treasury issuance, I think that spread could naturally come down on its own. And even back in 2023, I talked about how, look, don't worry about the spread. It'll come down on its own the more that rates stabilize and the more that it looks like we might see the more that we start heading toward lower rates. I think the main point is it's not like a variable that somebody can manipulate unless you're the Fed and decide, hey, I'm going to buy a bunch of MBS again. That would manipulate the spread. But other than that, it's just sort of a byproduct of what's going on in the market.
Okay. So and because that's something that they have demonstrated that they do not want to participate in.
Right.
Right. So it's not a really relevant thing to pay attention to right now.
No, it's not. Not at all. What's relevant to pay attention to is the overall rate landscape. And unless you are actively a professional in the mortgage industry, you're just fine paying attention to treasuries. Just try
Yeah.
to keep an eye on, a 5-year and a 10-year maybe. And you can take note if there's some vast difference in performance between the two. But in general, a 10-year treasury, 5-year treasury, great thing to pay attention to if you want a general sense of how mortgage rates are going to be moving.
Yeah. Yeah.
And I'll
Okay.
add that the spread between mortgage rates and treasuries changes so slowly in the big picture that, you're not really missing anything just by looking at treasuries. And as you do that, mortgages will be moving in the same direction as treasuries on any given day for the most part. And there might be a few victories that are a little bit bigger for one than the other, and those add up over time to bring spreads back down.
Hmm.
But it's not some singular major victory that causes a big shift.
Yeah. Okay. Interesting. Well, as 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 you know, and everyone listening knows, like the far majority of people that I teach and work with are in the medical field, are physicians, and um, I get some specific questions about, oh, like I want to buy a home, but I'm waiting on, I'm wondering if rates are going to fall, or like I have a home and the interest rate, I've got a 30-year mortgage at 7%. Um, I wanted to throw like a hypothetical your way and see what you think. Um, Assuming somebody has the time latitude to decide when they're going to buy. And for a
Right.
lot of doctors, especially like when they move, they're like in years of training and then they like move to their first big higher paying job. And a lot of them want to buy a home soon. I encourage
Right.
them to take their time for a lot of intangible, non financial reasons. But that notwithstanding, like when they have the financial ability and they can choose when to buy, or if there's someone that is like that has a mortgage and it's like 7%, and they're looking at rates and they're like, well, I could get 6.5. And with closing costs and everything, they're like, oh, the break even point. They look at how many months it would be until they
Sure.
broke even. And let's say it's like 11 months. They're like, oh, should I wait or should I take it? People ask me that all the time. Um, I know you don't know the future any more than I do. And from what I've heard from you so far, there is we shouldn't rely on this sort of information to wait if it's the right life decision. Is that an accurate assessment?
And that's my thesis when it comes to whether somebody should buy a home. Refinancing can be a little bit of a different consideration, but yeah, in general, especially when you're talking about your primary residence and you're not talking about buying investment property or second homes, it has so much more to do with the home and the real estate market than it has anything to do with interest rates. And I have a primer on my website for mortgage pros that I often repost because when I was in my 20s, as you may be able to relate to, I knew everything and was more than willing to venture bolder guesses on what things would do in the future. But now that primer that I post is called Predictions Are for Suckers. And I explain why that is with specific reference to rate movement. But it's really simple if you think about it. You have financial markets, traders, people that are trying to make money and preserve money for a living that can trade the stuff that's making rates move all day, every day. They're not going to leave money on the table if there's free money to be had. And if you or I could pretend that we knew with any degree of certainty what was going to happen tomorrow, the next day, next week, so can they. So can these traders. And there would be no reason for them to wait to make that money. In fact, they'd be losing money if they didn't act on it.
Mm-hmm.
And by acting on it, they are changing the rates that are available to us today in that now perfectly reflect the sum total of all future expectations. So anything we can know about where rates are going in the future is already priced in to where they are today. It is pretty much always a perfect coin flip as to whether rates will be higher or lower in your time frame. The same is true for late 2022. I bought a house in late 2022 and did that with a 5-year adjustable, thinking there's no way that by 2027 rates won't be a little lower than they are now. I could probably still get lucky with that, but here we are. It's almost 2026, and rates are where they are, same place. I did figure they probably wouldn't be too much higher, but also in my status as a guru to many, famously in my live chat on my website, we were talking about what was going to be the ceiling for rates on the way up. And I really didn't see us going much above 5%. And that was a popular thing to revisit in the chat history when we hit almost 8%.
I
So
imagine.
you never really know where it's going to go.
Yeah.
And you want to make sure that when you take that loan out, that you could pay that loan for the rest of your life if you need to. Something that people definitely didn't do in 2006 through 8, but that I think people are a lot better about these days.
Yeah. Yeah, I'm glad you mentioned that. There's a lot of people ask, well, I know that this would be tight right now, but if rates fell and I could refinance, then it would be so much
Yeah,
easier. And
don't do that.
that's a major red flag, right?
Absolutely, absolutely.
Because you're putting yourself into a position where now you are like no one, obviously, as everything we've discussed, no one has, no individual, or even there's not a knowable path to lower rates. Like we don't know what
All right.
that maybe that'll happen in 20 years, right? And
Yeah,
then
and
well,
maybe it'll
then you
happen
can
next year, and it'll be a pleasant surprise. And lucky you'll get to refi.
yeah,
But in case you don't, make sure you can keep making that payment.
yeah, yeah. Amen. Yeah, we gotta plan on plan as much as we can on based on what we know to be true, and
Yeah,
like what we know will be the case.
yeah. And
And
I
then
would never wait. I would never wait based on expectation. I would never wait to refi. If refiing benefited me a lot right now, I wouldn't wait for that just because somebody said something might happen. They don't know, and they could be wrong. Uh, a lot of people tell people to do that because the Fed's going to cut rates. And then what have we seen the last 2 times the Fed cut rates? Mortgage rates went higher. So take the bird in the bush.
yeah, 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 totally agree. And like I think I I think that the refinance decision a little bit more because you're already in the home. That's more of like a, I don't know, like a cash flow adjustment
Sure.
decision that like it's not like life changing of a decision. And like I mean
Right.
personally I'm even in the midst of that right now. Like we've gone back and forth with our mortgage banker, and like we could move forward and save some money per month, but it's not so much that we're like, okay, let's go through the trouble. It's like a, what do you call it? I've heard some planners, they call it return on hassle.
Right. Yeah. And resetting your amortization time frame, incurring a little bit of closing costs. There'll be some break even on that. So you know, the, everybody needs to weigh what their own trade offs are worth.
Yeah. Yeah. Okay, cool. All right, man. Well, this has been very interesting. I really appreciate you taking some time to share your thoughts. Oh, I did want to get your opinion. Um, and you can say no if you don't want to.
Sounds like it's going to be political. Let's go.
Well, I mean, I I've heard people. So the talk just this past week when we're recording this, there's a lot of talk online about the 50-year mortgage,
Yep.
and like on one hand, it's like, okay, well, this is butting up against the human lifespan, but it also, financially speaking, you are, you're winning from like a cost of living increase standpoint in terms of an inflation, because if you're getting in now, you're winning the game against the bank, 40 years from now, because your payment is still the same. Um, I think that it could be a tool that maybe it just becomes available, and I personally put it in the same frame as I do like how the company Affirm has inched its way into the lending market for like anything. Like you can, like Affirm does like Peloton bikes. You can borrow at 0% and get that in order to get the product. It's like
Right.
accessibility in exchange for leverage. Do you have like do you
Yeah,
see
I have all
anything?
kinds of thoughts. I spent all day today talking about 50-year mortgages. And there was an article on CNBC that had a few quotes of mine in there. So these will be a little bit of a rehash for people who have read those. But first off, on the notion of beating the house in some regard, I don't think that that's any more true than on a 30-year loan. You're just doing, whatever you're accomplishing by locking in your rate today and your term today. you're just doing it for a longer period of time, and that's going to make your payment lower. It's also going to make your interest rate higher. It's also going to make the interest that you pay over the life of the loan significantly higher. And there are a couple things to understand with all that. So first off, your principal and interest amount are set by an amortization calculation that depends on the length of time that a loan lasts. And 50 years being so much longer than 30 years, you definitely want to take a look at what that looks like visually to see how much is going to interest and for how long, and how much interest you pay over the life of the loan if you kept the thing for 50 years. Most people won't, but if you did, it's a staggeringly high number compared to a 30-year, and especially compared to a 15-year. The other thing to consider is that a 30-year mortgage has a rich and deep pool of liquidity in the secondary market, meaning that the investors that buy and sell mortgage debt, they deal almost exclusively in 30-year mortgages. And that liquidity and familiarity means that they are more competitive. They're offering higher prices, and they know that they can sell and buy as needed to conduct their business. If you introduce a 50-year loan into that mix, it's a wild west frontier that nobody really knows what the secondary market would look like. And at the very, very least, with a certainty that the rate will be higher than a 30-year fixed rate. If a 30-year fixed is 6.25% today, maybe a 50-year would be around 7%. I don't know for sure, but that would be a fair guess. And that means that for a $500,000 loan, you're just saving a little over $100 a month. Between a 30 and a 50-year, assuming the rate's a little bit higher. So I think the shortest answer I've been giving people is I would look at a 50-year loan the same way I look at an interest-only loan, because for most of the time you're going to have that. You're just not paying down principal. And the same is arguably true for a 30-year loan in the early years as well. But it's way more true for a 50-year loan. So if you're the type of person that says, yeah, I would love to have a lower payment and I'm going to refi this thing as soon as I can. First off, let's go back to that predictions are for suckers concept and understand you never know if we're entering a new regime where we're just never going to see 3.5%, 4% mortgage rates again. So you might not be able to refi. But even if you are, if you're the type of person that would be okay not really paying down your principal in exchange for that lower payment today, then power to you. You're not going to build quite as much equity, and you're going to be paying more interest than you otherwise would have. But if you need the cash flow from a monthly payment standpoint, a case could be made that it's not an idiotic thing to do. It's just not. If you have the means to do one or the other, you'll probably come out ahead doing shorter term.
Yeah. We lived in Sweden for a number of years, and all that you're saying right now reminds me of a lot of conversations I had with homeowners there, because they're largely on interest-only systems there, and there's very little pressure, I haven't kept up on it since like now, but back in like 2018, 2017, 2019, around then, there wasn't any pressure to like pay principal. They're just like, just pay the interest. And like the real estate market there is interesting, like really, really hard to find a place to live at the time. So it feels like a very different game. And it's not that different though. I can see what you're saying. And so as always, it's like an it depends answer.
Yeah. And how do you manage your money? How much savings do you have? Like if you're the type of person that can pay off your principal if you need to, but you just want this cash flow to put the money to work elsewhere, and you're making more on your investments consistently, and you feel confident you can continue to do that, power to you.
Yeah. I wonder how that would turn into, as far as like how this would translate into the mortgage interest deduction with the $750,000 maximum, if they would adjust that, just because like it would be such a different animal. Anyway, that's a different conversation.
Yeah, no, yeah, it's another consideration. Just make sure you do the math is the thing.
Yeah, cool. Well, thank you for sharing, and thanks again for talking with me today. For any of you that want to follow Matt's stuff, you can find him on Mortgage News Daily.
Yep. That's a .com, and the other one's a .net.
Okay, mortgagenewsdaily.com.
Yep.
Okay. And then anyone that wants to get into the minutia of mortgage-backed securities, but I'm sure particularly any mortgage professionals that are listening, go to mbslive.net, check out Matt's stuff there. Some high quality, very intricate things that you all will benefit from. So anyway, thanks again, Matt, and I'm sure we'll talk again soon.
All right, thanks for the invite and have a good one.